Hi there, welcome to Sterlinx Global. My name is Jay, and I'm one of the specialists in Sterlinx Global, a UK-based accounting firm specializing in traditional business and e-commerce. For our discussion today, we will answer what is management accounting, along with its purpose and the tools and techniques to use for your business. What is management accounting? Management accounting is the process of collecting, analyzing, interpreting, and presenting financial information to support internal decision-making, planning, and control within an organization. It involves using accounting techniques and tools to provide accurate and timely information to management, enabling them to make sound decisions about the organization's operations, performance, and strategic decision. Purpose of management accounting. Management accounting serves various purposes within an organization, including: Number 1. Decision-making support. Management accounting provides relevant financial information and analysis to support decision-making processes. This includes tools and techniques such as cost volume profit or CVP analysis, budgeting, variance analysis, and other financial metrics that aid in evaluating different decision alternatives. Number 2. Strategic planning. Management accounting helps organizations in setting financial targets, establishing budgets, and aligning strategies with overall goals and objectives. This allows organizations to formulate effective strategies, allocate resources efficiently, and monitor progress toward achieving strategic objectives. Number 3. Performance evaluation. Management accounting develops performance metrics and key performance indicators or KPIs to assess the organization's performance against predetermined goals and benchmarks. This allows management to identify areas of improvement, take corrective actions, and evaluate the effectiveness of their strategies and operational decisions. Number 4. Resource allocation. Management accounting provides insights into the cost and benefit of different resources and helps organizations allocate resources effectively. This includes determining the optimal utilization of resources, identifying cost-saving opportunities, and evaluating the return on investment or ROI for various resources. Number 5. Monitoring and control. Management accounting provides mechanisms to monitor and control the financial performance of an organization. This includes regular financial reporting, variance analysis, and performance tracking against targets and budgets, allowing organizations to take corrective actions when needed. It's surprising how management accounting can serve many purposes for business. And now, let's take a look at how management accountants successfully turn these purposes into reality through the tools and techniques of management accounting. Management accountants use a wide range of tools and techniques to collect, analyze, and interpret financial information. We will discuss some of these, which also coincide with the purpose of management accounting as discussed earlier. Number 1. Cost volume profit or CVP analysis. CVP evaluates the relationship between costs, volume, and profit, helping businesses understand how changes in sales volume, costs, and prices impact profitability. Next, we have number 2. Budgeting, which involves developing and monitoring budgets for planning and control, guiding resource allocation, and setting financial targets to aid in effective financial management. Number 3. Variance analysis. This compares actual results with budgeted or standard results to identify variances and take corrective actions, ensuring that performance stays on track with a planned budget. The fourth one is number 4. Activity-based costing or ABC. ABC allocates costs to specific activities or products based on their resource consumption, providing more accurate cost information for decision making and product pricing. We still have 5 more tools to share with you. Let's move on to the 5th tool. Number 5, break-even analysis. This determines the level of sales needed to cover costs and achieve zero profit, helping businesses understand the minimum sales volume required to avoid losses and make informed pricing decisions. The next one is number 6, financial ratio analysis, which involves analyzing financial ratios to assess financial performance and stability, providing insights into liquidity, solvency, profitability, and efficiency for better financial decision-making. Number 7, capital budgeting. This involves evaluating investment opportunities and making investment decisions, assessing the financial viability of long-term investment projects to allocate resources effectively. Next, we have the second to the last one, number 8, performance measurement, which involves developing performance metrics and key performance indicators or KPIs to evaluate performance against predetermined goals and benchmarks, aiding in performance evaluation and improvement. And finally, number 9, decision trees. These involve analyzing decisions involving uncertainty and risks, helping assess different decision alternatives and their potential outcomes for informed decision-making. Management accounting versus financial accounting. The key differences between managerial accounting and financial accounting can be explained by different aspects. For focus, management accounting is primarily geared towards serving the internal users of an organization, such as managers and other internal stakeholders, to support decision-making, planning, and control. On the other hand, financial accounting is focused on providing financial information to external users such as investors, creditors, and regulatory bodies for making investment and credit decisions. For their purpose, management accounting supports decision-making, planning, and control within the organization, while financial accounting reports financial performance to external stakeholders. For the time frame, management accounting is future-oriented as it involves forecasting and budgeting to help managers plan for the future and make proactive decisions. It focuses on analyzing and predicting the potential impact of various decisions on future financial performance. In contrast, financial accounting is historical-oriented as it records and reports past financial transactions and events that have already occurred. For users, management accounting serves the internal users of an organization, such as management and internal stakeholders, including department heads, managers, and executives. It provides them with the necessary information to support decision-making and control activities within the organization. On the other hand, financial accounting caters to external users such as investors, creditors, regulatory bodies, and other external stakeholders who rely on financial statements to assess the financial performance and position of an organization. For scope, management accounting is more detailed and specific in nature, as it focuses on providing information that is relevant and tailored to the specific needs of the organization and its management. In contrast, financial accounting is broader and more general, as it follows standardized accounting principles and practices. For reporting frequency, management accounting reports are flexible and can be prepared and presented as needed, depending on the requirements of management and internal stakeholders, while financial accounting reports are standardized and periodic, typically prepared and presented according to specific accounting standards and regulations. For each provided information, management accounting provides detailed and relevant information that is specific to the needs of the organization and its management, while financial accounting provides general and compliant information with accounting standards. For legal requirements, management accounting is not mandatory as they are internal in nature, while financial accounting is mandatory, governed by Generally Accepted Accounting Principles or GAAP, or International Financial Reporting Standards or IFRS, depending on the jurisdiction. For the format of reports, management accounting reports are customized and tailored to internal needs. They are flexible and customizable, and their format may vary from one organization to another, while financial accounting reports follow standardized formats and are prepared in accordance with accounting standards. For reports, examples: management accounting reports include budgets, performance reports, and cost reports. Financial accounting, on the other hand, reports include financial statements like the balance sheet, income statement, and cash flow statement. Although, note that we only provided a general comparison between management accounting and financial accounting. The actual scope and usage of these accounting practices may vary depending on the organization's specific needs, industry, and regulatory requirements. Ultimately, through management accounting, you can make decisions with a plausible basis, optimize costs, evaluate performance, and align your strategies with business goals. Let management accounting drive your organization toward new heights of success. Good luck! But before ending the video, let us answer some frequently asked questions about management accounting. Number 1. What are the 3 pillars of management accounting? The 3 pillars of management accounting are planning, controlling, and decision-making. Planning involves setting financial targets and creating budgets, while controlling involves monitoring and managing financial performance. Decision-making relies on financial analysis and insights provided by management accountants to aid in informed decision-making. These pillars form the basis for management accounting practices and assist organizations in achieving their financial goals. Number 2. Can management accounting help small businesses? Yes, management accounting can be highly beneficial for small businesses as they often face unique challenges such as limited resources, tight budgets, and fierce competition. Management accounting can help them navigate these challenges by providing financial insights, budgeting and forecasting support, performance evaluation, and strategic planning. It aids in decision-making, saving costs, and monitoring financial performance. Number 3. What does a management accountant do in business? Management accountants provide crucial financial support to businesses through tasks such as financial analysis, budgeting, cost management, performance evaluation, and strategic planning. They provide valuable insights into decision-making, aid in resource allocation, and monitor financial performance, aligning financial goals with overall business objectives to drive success. And that's it for today's video. Thanks for watching. We hope our video helped you gain more knowledge on what management accounting is. For more professional advice on your tax accounting needs, consult us by visiting the Sterlinx Global website at sterlinxglobal.com. If you enjoy our content and want to explore more about similar topics, please like and subscribe to our channel. To stay updated, why don't you have a look at our other social media platforms? The links are in the description below. Once again, I am Jay of Sterlinx Global, and I will see you in the next video.